Awesome. Well, I've been really excited about this episode for a long time. This is episode 100, and we got a very, very, very awesome guest. The original gangster of the industry is what I like to see. He studied at Cornell University. He's done $4 billion worth of volume. They've done over 650 transactions at this time, and they've serviced 141 countries. And he's also the host of the Boardroom Buzz, which is one of the best pest control podcasts in the industry for sure. And so I'd like to welcome Paul Giannamore to the show. Thanks, Paul, for being here with us.
Right on. It's great being here, Jonas. I appreciate you having me. Congratulations on hitting 100. That's not an easy number to hit. I know that because I too toil in the podcast vineyards, and it's a lot of work.
Yeah, I think you guys are, if I looked last, through 179, 180, somewhere in there.
Yeah, I mean, Fat Pat would be able to tell you right off the top of his head, but yeah, we're somewhere in that zone for sure.
Yeah, that's awesome. Congratulations on that. Again, it's just staying committed, right? Just sticking at it. Like anything in life, though. Just got to stay committed and keep at it.
Or have a Fat Pat calling you on a weekly basis, dragging you into stuff. That's how I do it. Less commitment, more overseers and handlers. Yes.
Yeah, that's awesome. He's such a great guy too. We had Fat Pat on early on with Fraction. They do an amazing job too.
Right on.
Yeah.
You guys go to the same barber as well, I see. Yeah.
Yeah. We all share the same one.
Yeah.
Cool. So again, thanks for being here, Paul. I really do appreciate it. And I think I met you a few years ago, one of the events. And obviously, I listen to the Boardroom Buzz often as well. And I learned a lot from you already. And I know I've pulled you aside, asked you a couple questions, after the event. I've asked you a couple questions before this. So again, thanks for, all that you do for the industry. So why don't you take us back? I always like to ask this: who was Paul Giannamore in high school? So if you and I were sophomores and juniors in high school, who's Paul?
Ooh, that's a great question. No one's ever asked me that question. Yeah, I mean, look, I went to high school on the near west side of Chicago, and it was a shit school, quite frankly. It was a public school. Actually turned out to be probably the best thing that happened to me because I graduated at the very top of my class, and I probably wouldn't have been able to do that if I were going to a great school. So by doing that, of course, helped me get into a good university. I was, back in high school, I tried to play the guitar. I was not a sports guy. I'm extremely uncoordinated, so I wasn't able to do that. I started high school as a pretty shitty student, I think. And I realized probably around my sophomore year that I needed to cook with gas in order to get out of there, which is what I needed to do. So I became a pretty good student, I think. Yeah.
What was it that happened when you were a sophomore that really said, "Hey, I need to cook with gas to get out of this where I'm at"? What was it that set that off?
Yeah, I think it was largely, it was a couple of things. One of the primary things is I lost a couple close classmates to gun violence. So Chicago is a very, very violent inner city. And, I went to a school that was probably, it was probably about 25, 30% white. The rest were minorities. It was very, very street gang heavy. I would say probably, I don't know, half of my graduating class. Well, actually, I don't even want to say graduating class because a lot of them didn't graduate, but probably half my class was in some sort of a Chicago street gang. It was a school back in the 90s that, we were one of the first schools to have metal detectors. So you'd have a metal detector to get into class to make sure people weren't carrying a gun. So it was a particularly violent place. And, in my sophomore year, I lost a couple good friends. I lost almost, one of my best friends my junior year. She was shot in the chest 7 times. So, and I remember that it was a week before Christmas. I remember over our Christmas break going to her funeral, a girl named Courtney Hayworth. So yeah, it was a pretty bad place to be. And, most people growing up in that sort of environment really don't have any hope for the future, really. I mean, and, and the opportunity really back in the 90s in Chicago really came down to, especially in that area, is just being involved in the drug trade, really, because that's all there was. It was drug trade, prostitution. Of course, there was a lot of illegal gambling, but whatever street gangs ran in Chicago, that was kind of the opportunity. And while I think the profit margins were high and there was a certain degree of recurring revenue to that sort of business, the risks were not on a risk-adjusted return basis. It didn't make sense. It didn't fit into my calculations. So I decided, you know what, I need to bust my ass, get good grades, and get the heck out of Dodge. That's what I did. Jonas, you're asking me questions that a lot of people have not asked me, and I haven't thought about those things for a long time. So I appreciate you asking me. But yeah, I went to Cornell. I busted ass. I got good grades. I got a academic scholarship to Cornell. Cornell picked up 75% of the tab, which is great for me. I graduated Cornell, and thinking back, so Cornell was another one where now I'm at Cornell and I'm like, man, I got to do well. So I did well, and I graduated literally with a 4.0 at the top of my class and got scholarships to a bunch of, well, they weren't really scholarships, certain grants to a variety of different grad schools, which I decided not to go to. I decided to get work experience instead. So that's what I did.
That's awesome. And the reason I asked the question is because, you're one of the top 1% of the industry. And it's like, what makes these people what makes them different? And so I like to know where you came from and how you grew up to make the man you are today, and how you got to where you're at. So it's fascinating to hear the story of where the original G comes from.
Yeah, well, in my philosophy here in my business, we've got probably, I don't know, think of our organization here at Potomac, we got about 25 people, and I have a very strong bias to hiring people who grew up poor. It's like I want to hire people that are striving and actually, have demonstrated the ability to overcome some really difficult shit. A lot of people that apply for positions here, they have Ivy League pedigree, which is all fine and dandy, but I don't need, some third generation princeling who's never really had to work for anything in his or her life. I want to hire somebody who's really gone out there and demonstrated that they can overcome tremendous obstacles. So that philosophy has lived on.
That's awesome. And it's I feel the same way about wrestlers. They're just cut from a different cloth.
Yeah, I agree with that.
When we try to hire, that's what we're not doesn't have to be a wrestler, but sports athletic that are just been through a lot of shit too and know what it's like to have bad days, overcome obstacles, and they work hard by themselves, part of a team sport, but on their own. So if you haven't heard about GorillaDesk yet, it's a super sick software. It's actually made by one of my really close friends, Chris Moreshi. So Chris built GorillaDesk to help streamline his own personal business over 10 years ago. But now GorillaDesk is used by over 4,000 companies. And today it's become one of the most premier platforms in our industry. So what's really unique about GorillaDesk is that it's a simple all-in-one solution that's really easy for your team to use. GorillaDesk offers a seamless onboard experience and best-in-class support with no additional cost. It's all included in your subscription. Inside the software, you'll find a whole suite of features. Scheduling, invoicing, routing, and sales pipelines, integrated VoIP, text messaging, and pretty much all the automation you're going to need, and much, much more. So if you guys are still relying on paper or spreadsheets or fighting with an old software, I highly recommend that you guys check out GorillaDesk. So we have a link in our description. Click on that, and it'll take you right to their free trial. Now let's get back to the show. How do you go from graduating to Cornell, pass up on grad school, and then where do you go next with life?
Yeah, so when I was at Cornell in Ithaca is in the middle of nowhere. It is just a treacherously isolated community in the middle of New York. But it was a great environment to go to school. And when I was in, I think my junior year in college, I started a business exporting farming and machinery equipment from the US to Europe. And it was a really bizarre sort of events. My family is Italian. Most of my family is still in the greater Rome metropolitan area. And I remember going there on vacation one Christmas. We were back home for Christmas, and this was in the 90s, and somebody showed me a Polaroid of a combine attachment, which is something that if you're not agricultural, you're not going to necessarily know this, but it's a piece of machinery used in farms.
I grew up on a farm.
The guy said, "Oh, so you know exactly what this sort of stuff is."
We had a few of them.
Being up in Michigan. So, and what ended up happening is, I can't even remember where I was at a store, and some guy said, "Hey," a friend of the family said, "Hey, you live out in the Midwest. There's a lot of farms out there. We need to buy these Case New Holland or John Deere, whatever the brand was, of machinery and equipment. Can you get us some used stuff?" And I was like, I don't know anything about that. How old was I? 20 years old. So I remember going back home, and then I was driving to see a buddy. I was back in the summer. That following summer, I was driving from Chicago to the western shore of Michigan, up in the Holland area. I kind of went around the lake, and on my way over there, I drove by a farm that was going through bankruptcy. There was an auction going on. I just pulled off the side of the road, and I saw that sort of same equipment, and I wasn't sure if wasn't sure. I still had the photo at home, but I kind of looked at it, and I called my father up and said, "Hey, can you explain what this looks like?" Turns out they had very similar equipment. So I called the fellow over in Rome and I said, "Hey, is this what you guys are looking for?" And he said, "Yeah, I'll take that." Now I'm at an auction, and I didn't know anything about farm auctions. And so I rolled up. I was driving a 1987 Chevy S10 pickup, and I rolled up into that thing, and I bought probably a $7,000 or $8,000 piece of equipment for like $500. And so I went there, got scrounged up some cash from some buddies, bought that thing, and then had to figure out what the hell to do with it.
Yeah, you're not going to haul it with an S10.
No. And they said, "Hey, you've got 24 hours to get this out of here." And I had a fraternity buddy who his father worked for a company called Hapag Lloyd, which was a freight brokerage company. And I called him up, and I got on the phone with his father, and he said, "Here's what you can do." And long story short, I figured it out, and I was able to get it out of Michigan and get it in a container and get it shipped overseas. And I think my profit was like maybe $900, maybe $1,000 back then, but this was in the mid 90s. And so I was just like, man, I just figured out I got a business. So my college roommate and I set up a company called Global Resources, and that's what we started to do. We started to buy shit and export it to Spain and Italy. And we did that my junior and senior year. I got out of college and decided, hey, this is what I'm going to do. I'm going to make a run of this. And about 3 months into it, I realized, like, from a profit perspective, this was going to ultimately go nowhere. I mean, one of the key ingredients is my father worked for an airline. So I was able to fly from Chicago to Milan round trip for like $100. Once I got out of college, I didn't get flying privileges anymore. So that ticket just went from, $100 to $1,000. And that really impacted my margins. So I had a buddy who's like, "Hey, I'm doing this thing called investment banking. You should do this." And I had no idea what the heck that was, but it paid a lot of money. So I decided to do it.
What did you go to school for?
I went to, Cornell's School of Industrial and Labor Relations, which is basically unions, negotiation, that sort of stuff. And I only did that. I had no interest in labor, quite frankly. I did that because it was a very important law school, feeder school on the East Coast. So ILR is the tiniest college within Cornell. It graduates a couple hundred kids a year. And getting into ILR gives you the opportunity to pretty much go to any law school you want. So that was going to be my plan. And then I decided, I don't want to work for, I don't want to get paid dollars. I learned at a relatively early age that wage earning dollars per hour, selling my time, wasn't the most appropriate way to get leverage in my life. So I decided not to do that.
So then you go to investment banking.
I did Lehman Brothers in London for 3 months. I met a deal team at Credit Suisse. I did Credit Suisse for a couple of years, industrial M&A. And then from industrial M&A, I went out and worked for a guy named Frank Quattrone in the tech M&A group in California. I did that for a couple of years, and then I left investment banking and I went into private equity. And I was in private equity for 2 years. And then in 2003, got out with one of my Cornell roommates. He was working for a company. I was working for American Capital, and we decided to put together Potomac. That's what we did. And we lived on Bay Street, and so the predecessor to Potomac was Bay Street Capital. So we started Potomac, or Bay Street Capital at the time, and basically focused on middle market M&A. And that was in 2003. So 21 years ago.
The podcast is split between, fertilization weed control companies and pest control companies. So a lot of the pest control industry has heard of the Potomac Group. But for the green industry, a lot of them probably haven't heard of the Potomac Group. So can you just kind of tell us what you guys do over there?
Yeah, great question. We're basically pure and simple sell-side M&A advisors. We don't do any buy-side work. Well, let me qualify that. We actually do a ton of buy-side work. We probably do 60 or 70 transactions a year on the buy side. We don't get paid for that. We don't charge for buy-side work to our current clients, because we've got clients who are trying to acquire businesses prior to ultimately going out in the market and selling their businesses. So we do that sort of stuff on an ad hoc basis, and we do it gratis in order to basically help them build scale. But we advise on sell-side transactions. That means we represent sellers in competitive processes. We're based here in San Juan, Puerto Rico. We've got folks all over the world. We do transactions all over the world. The majority of it, of course, is in the U.S. because it's the bigger market. But we do transactions in Europe and Southeast Asia and the Middle East. We have been in pest 20 years now. Now, we have gotten involved in the green industry to a certain degree over the years. I mean, I think our biggest engagement in lawn care was in 2011. Scott's Miracle-Gro Company engaged us for a 4 or 5 year period. At the time, SMG owned Scott's Lawn Service, which is now a part of TruGreen, and that has been a part of TruGreen since, I think, end of 2015. But when SLS brought us in, they had about $250 million in customer revenue on the lawn care side, and they wanted to get into pest control. And so they brought us in to advise them how to do that. And that was either through cross-selling, starting greenfield operations, or going out and making acquisitions. It was a very interesting engagement for me. I learned a ton. I met a lot of great people. We completed a transaction in 2014 where Scott's Lawn Service entered pest control and bought a business in Indiana called Action. And then shortly thereafter, Jim Hagedorn, the CEO, decided to go from weed killer to killer weed. He decided to get into hydroponics. And so he basically shut the whole pest control idea down, turned around, and carved out SLS, which is now part of TruGreen. We do somewhere between 50 and 80 sell-side M&A transactions per year. Some of the statistics that you read earlier in the session are older. We on average now do well over $1 billion in transaction volume per year. Some years we do quite a bit more. We were involved in the Rentokil Terminix transaction, which was a $7 billion deal. So if you add that all in, that was a big year back in 2022.
Yeah, I was going through some of the ones that you had you post on your website, and that was my next question. What is the largest deal that you've done?
Yeah, I mean, the largest transaction we've advised on, and again, we didn't. When we did the Rentokil Terminix transaction, we were advisors along with some other advisors. Lazard Frere and JP Morgan were on there as well. And our focus was doing the European antitrust dispositions. There were some businesses in Europe that Terminix needed to sell off so that the regulators would actually approve the transaction. They needed to happen quick. They needed to be done right. And so Terminix brought us in because they knew we could surgically go in and peel off those assets within 90 days, get deals done at great prices, and let them move on with the transaction. During my Potomac era, that's our largest transaction. There were certainly larger ones back when I worked for Credit Suisse, which is a massive international investment bank. But on our own, that was the bigger one.
Awesome. So why pest control?
Yeah, I mean, look, I stumbled upon it. Really, I didn't aspire to do this. No one does, right?
None of us. Yeah.
I mean, maybe there's some people that do, I guess, but and it certainly wasn't to help me get chicks either. It was one of those things where I was doing M&A back in the early 2000s, and I had a guy call me up who ran a M&A firm. He said, "Hey, you're on the East Coast. I'm on the West Coast. Can you help me? I, I'm doing a small deal with a company called Terminex now. And can you help me? I don't want to fly across country just for this small deal. So could you go up there? And can we partner on this?" And I had known him for years. He trusted me. I trusted him. And I said, "Sure, I'll do that." I didn't even know what pest control was. I mean, my interpretation of pest control was literally from like watching Seinfeld episodes with like Stan the Exterminator or whoever that guy was. Like I'd heard of Terminex and Orkin, but I didn't really realize what a large business it is actually. And it's certainly, I mean, don't get me wrong. The industry is quite different now in 2024 than it was back in 2023. But
yeah, I remember you said back, I remember hearing a podcast a while back. So you were saying like back when you got in, they were like doing these deals in the back of a napkin.
Literally. Yeah. Yeah.
And then you came from the M&A world already. So you brought sophistication to the industry.
Well, I tried. But yeah, it was a very different, everything about it was different back then. And it's much more developed now. But, I didn't aspire to get into it. And it was just one of those things where I looked at it. We were generalists. And what I mean by that is we would advise in any sort of industry when we first started out. And what we ultimately, or what we began doing is advising private equity firms on dispositions or sales of their portfolio companies. That's how we got our start. And we did that because both of us were M&A bankers who got into private equity and left private equity to start this firm. So we had a lot of experience in private equity as well as a lot of contacts and relationships. And so that's what we started doing. But then very quickly, I realized we needed to specialize. And I, at the end of the day, was a tech banker. I was doing like SaaS companies and software and contract manufacturing. And, I was literally in meetings with Michael Dell, not too long prior to founding Potomac, while I was at Credit Suisse doing, all this tech related stuff. And so pest control was extremely foreign to me. The good news is it's not particularly complicated to figure out. And so we decided we needed to specialize. And so I started to go after basically route-based recurring revenue businesses in Europe. And we've been in Europe for just as long as we've been in the United States. It's more facility services types transactions than just pure play pests. They tend to be more integrated. In the United States, there's a lot of pure play pest companies, whereas around the world, you'll see a lot of companies that do, pest and other facility service related type things.
Such as cleaning,
the hygiene stuff. You're right. Any sort of building services, much less on the lawn. And, there's not a whole lot of lawn and fertilization. I mean, it exists in Europe, but to a much lesser extent. I mean, it's largely a phenomenon that takes place in the United States, Canada, and Australia. Those are the bigger countries. I look at it as kind of the common law countries are more into lawn care.
Yeah. And I know you're making the shift to lawn care, like you said. What was the reasoning for that?
We've started to get more into, look, we're doing we'll be in Orlando in June at the Fire Protection Conference. We're doing a handful of deals in fire protection, which is another recurring revenue business. We've kind of broadened out into resi and commercial services, kind of really getting back to our roots and what we started in. I mean, back in those early days, it wasn't just pest. We'd done lawn care, landscaping, paving, and a variety of different resi and commercial services businesses. And now it's just time for us to expand. I mean, the firm we add on one new Potomac team member every 3 weeks, and that's been going on for the last couple of years. So we've continued to expand, and just now's the opportunity for us to do this, I think.
For sure. So what value do you see in the green industry?
In the green industry?
Yeah.
What value do I see?
Because I see a lot of people moving away from the green industry, getting into more pest control, not the other way around.
Yeah, I mean, look, the green industry if we take lawn care, and when I'm saying lawn care, let's specifically talk about, the fertilization, actually taking crappy lawns and making them look nice, right? That is a business is very similar to pest control. The customers tend to not be as sticky, right? So if you compare residential pest control to residential lawn care, you tend to have, average duration of customer on the lawn care side is probably somewhere around 35, 36 months, whereas pest control tends to be north of 50 months. Um, but it's still recurring because you got them there for at least 3 years. The margin profile is it's similar but lower on lawn care. I mean, lawn care obviously uses bigger and more expensive vehicles. The materials and supplies in order to perform a lawn care service are typically twice that of pest control. So it's not as profitable, it's not as sticky, and it's not as capital light as pest. But it's still a damn good business. The difference, when my line of business tends to be different. Well, let me rephrase that. I tend to think about things a little bit differently, I think, than a lot of people do, because I'm not just looking at margin profiles and whether a business is capital light or whether it's growing. I'm always trying to understand, most people, the smart people that get into these businesses to build an asset that they're ultimately going to sell. Now, the majority don't. The majority stumble on into lawn or pest and say, I'm going to build this business and provide for my family and so on and so forth. But you're getting more and more guys who are like, okay, if I'm going to do this, I'm going to do this right. I want to build an asset that I can monetize for 10, 20, 50, $100 million at some point in the future. And historically, there has been better exit opportunities for pest control operators than lawn care operators. From I don't know, as far back as I can remember, the 90s through roughly the mid-teens, so 2015, 16, both pest and lawn were largely businesses that were acquired by strategic acquirers. And when I use the term strategic acquirers, I mean industry buyers, right? TruGreen, Scotts, Orkin, Rentokil, the big companies that are operating in the industry, they were largely the acquirers of those businesses. In pest control, we had a duopoly. It was Orkin and Terminix, largely until the 2010, 2011, when Rentokil really started to ramp up in the U.S. And in lawn care, you had typically TruGreen, and then you had Scotts come online for a year or two and then disappear and then come online. And then you had a few other regional players that were ultimately pretty much acquired by TruGreen. But you didn't have a whole lot of buyers. And I remember the period from approximately Scotts and TruGreen quit making acquisitions for the most part in around 2012. TruGreen had a lot of problems. We remember we had the Service Master spinoff and all those sorts of things going on. They had high leverage. And then SLS started focusing on pest and other things. So you had a period of 5 or 6 years where strategics really weren't buying lawn care businesses. And if they were buying them at 70 or 80 cents on the dollar, which was not a great price. Now that financial sponsors have gotten into the business, private equity firms going out doing these roll-ups, it has really changed exit opportunities across the board for both lawn and pest. But pest still enjoys greater exit opportunities than lawn.
So what about companies like, say, like a Massey that does both? Do they have to split that revenue up in pest versus lawn?
You're saying when a company like Massey ultimately exits?
Yeah. And they do multi-services like that.
Yeah, I don't really think so. I mean, I think when you look at Massey, a company like Massey would likely have, it's getting to the size level where taking it public is an opportunity. So you have, number one, the public markets. Number two, you have the financial sponsors, the private equity firms that would likely pay more for that business than a strategic acquirer. So I think those are the top two strategic alternatives for a company like Massey. I would say that you don't always have to split that stuff up. I mean, hell, Orkin just sold. Actually, I don't even know if this is public yet. I mean, at the beginning of this year, Orkin in the Southeast, they just sold off a huge chunk of their lawn care business. I mean, so these companies are constantly getting rid of lawn care. I don't think Massey would have to split it up.
Gotcha. Do you see that as an opportunity in the lawn care space then? Well, because there's just not a lot of strategic buyers, right? Doing roll ups, things like that. So do you think that's just an opportunity for the lawn care people that are listening to like? There's just a lot more companies for sale.
Yeah, I mean, look, I think there's now there are growing platforms in lawn care, right? You've got one in Texas, you got another one in the Southeast. So there are growing private equity, Incline Capital Partners is in one, Morgan Stanley Capital Partners is in another one, and I can think of 7 or 8 more. So you now do have private equity backed platform businesses that are um, making acquisitions for lawn care businesses. So I think right now in 2024, lawn care operators have more exit opportunities than they have had in the last 2 decades.
Yeah. Yeah, and I guess even a statistic that's saying that the majority or 80, 90% of all companies that are selling the lawn care space are from like 2 to 5 million.
That sounds about right.
Yeah, why do you think is that like a really hard spot in business, or why do you think they sell out there? Or is that just what private equity is looking for?
Yeah, you know, I do think it's hard, whether it be lawn care or pest control. I mean, hell, look at pest control, for example. I mean, if you've got 20,000 companies in the United States, the median revenue is probably like 750K. We all know companies out there that do like $2 million per year in revenue, and they've done that for 15 years, and that's just what they're going to do. If you look at, you know, when I talk to business folks in both lawn and pest, you've got two classes of people. You got guys who, if we take a step back for a second, I always say you get your returns from a business in one of two ways: capital appreciation or dividends, right? You're either reinvesting in the business and growing it and building it a larger business that you can monetize, or you're taking dividends out, right? So, for example, you might have, a $2 million in revenue business that kicks off 400K per year in cash flow. Some guys are willing to take 50K a year out of that and invest the 350 back in to grow it. And other guys are like, give me the 400K. I'm going to buy my Porsche. I'm going to take my vacations. I'm going to do whatever, my hookers, the cocaine, all that sort of shit, whatever they want to do. That's fine.
Yeah.
But you get it in one of two ways. And having dealt with so many companies over the last 20 years, I really get a sense of how a lot of these owners think. And the extreme majority of owners are more taking their returns from dividends. Sure, do they want to grow a business? Yes. Who doesn't? But at the end of the day, you can't have your cake and eat it too. So I just think, to your point, Jonas, I think there is a size which is kind of big enough for most people who, not everyone wants to be worth $100 million or what have you. And I think that's really what it is. It's more of a mindset than anything else.
Gotcha. So yeah, I mean that company's 2 million. They're making 400,000 a year. They're just happy. They have their Porsche, their drugs, or whatever. Like you said, hookers. Yeah, that's a great company. So you just see that that's kind of the sweet spot that they sit in, and they just get the returns, and they end up selling.
Yeah, that's right. I mean, because if you think about it, like any one of these businesses, if you can get it to 5 million in revenue and it can kick off $1 million a year pre-tax, I mean, I would say there's probably not many people in the United States that wouldn't be happy just making $1 million per annum pre-tax.
And then the way that the private equity companies are looking at it, like, hey, this company's been stuck here for at $2 million for the last 5 years. There's so much opportunity. So that's the area that these private equity firms are looking for, because they know they can grow those things pretty quick.
Yeah, I mean, I think whether it's a private equity firm or a strategic, you find these businesses that are, doing $2, $3, $4, $5 million a year in revenue. There's a lot of value creation in, number one, systematizing the business and putting it on software and all sorts of stuff that these guys are on. Not all of them, but a lot of them. And then just thinking about all the other things that you can upgrade with regard to the business. There's a lot of value creation that can be made. And so, yeah, they'll roll those things up. And, you buy 5 or 10 of these things in one market. Now you get density. And with density, it gives you higher gross margin. With higher gross margin, higher cash flow, more money to invest back into the business, and it kind of snowballs from there.
I love that you said that. So let's just say you went out and acquired 2, 3, 4, 5 companies in the same market. Do you typically see those companies, like I say, Terminix, changing the name right away? And I know I heard this on a podcast before. Do you typically see those companies changing those names right away? Are they holding on to them with the same name, run them separately? What do you like to see like that as well?
Yeah, interesting point that you brought up. I was down with Jerry Galhoff last month in Atlanta, and we were sitting at lunch, and Jerry is the CEO of Rollins, the parent company of Orkin, and we were talking about, he's relatively new to the job. He's been on for a year and a half now, and he's been around for a long time. And we were talking about how Rollins used to do deals. So Orkin would go out and buy a business on June 1st. And on June 2nd, it went from, Jose's pest control business to Orkin.
And True Green was the same way.
Yeah, exactly. And it was a really stupid way to do things because you just destroy a lot of value right out of the gate, right? But here's the thing. They didn't have to worry about that back then because they were paying such low purchase price multiples for these businesses that they were accretive irrespective. They could lose half the business in the first year, and it still made financial sense for them to do those. As valuations have gone up and the market has gotten more and more competitive for quality acquisition targets, they've had to become more judicious and really think about what they can do to mitigate their downside. And so that's what we have seen them do. And so now they don't, it's very rare. I mean, I'm trying to even think about, I can't even think of a case study in the last couple of years where somebody changed the name in less than 6 months. I mean, I'm struggling to think about.
Do you see them, like, let's say after the 6 month or a year period or 18 months, do you typically see them change the name then? Or will they just say like division of?
Well, yeah. I mean, I think certain companies have more focus on branding than others. For example, Rentokil's bought hundreds of businesses around the world and just kind of left them the same name. And over the years, they've become, a XYZ company, a Rentokil company, and they've just stacked them around. If you take a company like NTCMEX, they've gone out and they've bought platforms in different regions. So you starting up in New England, they bought Modern Pest Services, and then JP McHale in New York, and then Viking in New Jersey, and so on and so forth, all the way up and down the coast. And they've kept those businesses. Those are the NTCMEX brands. They've kept those businesses. But every single add-on that they do, like every deal that Jim McHale does in New York, that ultimately turns into Jim McHale or JP McHale within a very short period of time. NTCMEX is really focused on consistent branding in the region. They don't need 15 different brands in Jim McHale's market. They want just JP McHale. And I think that we'll probably see that practice consistently throughout the industry. I mean, even Orkin's doing it, right? Northwest is buying stuff, and within short order, they're changing things over. The big thing is, it's not whether or not it ever becomes Orkin or becomes JP McHale. It's just the time in which you do it. You should probably stretch it out over a period of a year so that the customers slowly begin getting invoices with the new company's name on it. And the uniforms can change, but they don't change like this right out of the gate, because then people, once the customer understands that the service is the same or better, then they can afford changing it. But until the customer understands that, you're in danger by changing that.
For sure. So as far as as you're exiting the company and let's say you have multiple brands versus one brand, would you get a better evaluation? Or because it's under the same umbrella, it doesn't really matter?
I don't think it matters.
It's good to know. I love that.
Yeah.
You brought up private equity a couple times now. What does selling to private equity really mean?
Private equity firm is really it's an asset manager that invests in privately held businesses. So if you think about, like, it could be, a pension fund or any sort of institution that wants to allocate capital to private markets as opposed to just public markets, publicly traded stocks and bonds, will allocate money to private markets. And a private equity firm is effectively, it's an advisory firm that establishes a fund, and the fund is typically a 10-year closed-end partnership. And There's a general partner, which is typically the private equity firm. And they often kind of what's customary is they put in 1 to 5% of the money into the fund. And then they go out and they raise money from LPs or limited partners. So high net individuals might invest in that, institutions, and they'll invest into the fund. And then the private equity firm, as the advisor of that fund, goes out and makes acquisitions. And the private equity firm is compensated typically with what's called a 2 and 20, a 2% management fee that they get per annum for managing the money. And then they get 20% of the upside, and that's referred to as the carry. So without getting too technical, there's European style waterfalls, there's American style waterfalls, and it can kind of get complicated very quickly. But I think what everyone just should think about is private equity firms go out, they raise money, they pool it together in a blind pool, and they go out and they make investments in privately held businesses. And they do that in a variety of different ways. They could do a majority recap or a buyout, where they can go out and buy out either 100% or 80% of a company. Or they can do growth investments, growth equity investments, where they might invest and own 40% of a target and be minority shareholders and help a business grow. There's a variety of reasons why somebody would want to do that. You might have a $100 million lawn care business and say, you know what, I want to take this business public. But I know I really got to grow this, and I've got to upgrade management, and there's a million different things that I need to do. And so I need a sophisticated partner that actually has taken many companies public before. So you might sell 40% of your equity. So you hand over 40% of your equity in exchange for a check, put that check in your pocket. And now you've got a partner who can help you do a myriad of things that you couldn't do on your own. First off, you're part of an ecosystem with a bunch of other portfolio companies, and those are the companies that are also owned by the private equity fund. So you've got all these other CEOs and maybe allied industries that you're able to network with. Private equity funds will typically have all sorts of different experts on tap. They'll have like brilliant HR people. They'll have like SEO and online marketing pros and all sorts of folks that you might not otherwise be able to afford that now you can tap into. They're going to impose governance on your business. You're going to actually have to probably for the first time have proper board meetings and proper board books and proper reporting. And you might need to now be audited by an external auditor and all sorts of things. But it's basically getting your company ready for the big league. That's a growth equity investment. A buyout is, look, I own a $20 million pest control business and it's kicking off a lot of cash. But now I'm at the point in my life where I want to enjoy some of the fruits of my labor. Let's say you're 50 years old, right? And you're like, hey, this thing might be worth $100 million. I don't want to sell it because what the hell am I going to do? But I do want some of that money. So I'm going to do a $100 million enterprise value deal, and I'm going to take $70 million off the table. So I'm going to collect my $70 million. I'm going to put it in the bank, and I'm going to roll some equity. Now I'm going to own 30% of Newco going forward. So what I've done now is I've de-risked myself to a certain degree. I took that $70 million. I can buy my castle in the south of France. I can buy that big yacht that I've wanted for the last 30 years, but haven't been able to do because I haven't had the money. So I get to do all those sorts of things, but I'm still running my business. I'm no longer the boss. I've got a board, but at the end of the day, I'm still in charge. And now I can use somebody else's money to help me go out and do acquisitions and grow this thing. And then at some point, the great hope is that 3, 4, 5 years in the future, I'll be able to sell my remaining 30% for more than I got on my original. That's the proverbial second bite of the apple, right? And so those are some of the benefits of selling to private equity. I mean, there are certainly some potential downsides too.
Which I've heard a lot of. Can you walk us through just an example of that you've seen recently of the downside?
Of downsides? Yeah, I mean, when we talk about private equity deals in the green industry as well as in pest control, like not a lot of these are growth equity investments or minority deals. The extreme majority of them are buyout transactions. So when you see these things happening, for the most part, somebody has sold a majority of their business. And so now they answer to somebody else. And private equity firms are not in the business to run lifestyle businesses. They're in the business to grow. And so I find that some of the biggest complaints are, some of the private equity firms are really focused on upgrading staff. And if you look around your business, I mean, I think everyone could look around their own business and say, hey, I got some wicked, great A players, but I also have some B and C middling performers. And you might care for them, but they're probably gone. They're not sticking around because the private equity firms are going to be focused on upgrading talent. And that's the way it should be. And that's the way you should have been doing it, but you weren't. And I should have been doing it, but I wasn't. But at the end of the day, you've got that. You've got, a lot of this stuff, the tide hasn't gone out yet, right? So a lot of these transactions that have taken place at extremely suppressed yields over the recent years are at extremely high valuations. So what the return parameters will look like is still yet to be uncovered, right? Because they haven't exited these things yet. And so we're seeing very, very crowded spaces, not only primarily on pest, but even on the lawn care side now, where you've got 8 or 9 different PE-backed platforms doing deals. There's a lot of competitive pressure, and how these will all turn. I mean, some of them are going to be blockbusters and some of them are going to go total bust. So the question is who? I think the problems that people ultimately have is, again, not revealed yet. Because, and what I mean by that is, when I look at some of these deals, I see some of these sellers that have entered into transactions where they don't really understand what the capital structure looks like and what sort of protections and consent rights various people have. And
so they think they're going to get a check for $20 million and then I'll ultimately find out they're only getting $5 million a year later, right?
Or they're getting nothing. Like, for example, there's a private equity firm that the Mexican has blacklisted over here. But they've gone out and they've tried to do deals where they have a very, very high liquidating preference in their favor, meaning that if there's any sort of problem whatsoever, these guys will get paid out. Not only will they get paid out their original principal, all their investors, their LP, will get 3x their money before their partners. So the seller sees a single nickel of his rolled equity. And it's not extremely apparent to somebody who's never done this before. And a lot of the attorneys that are not used to doing these sorts of transactions will not understand what's written in the equity participation agreement. So floating around in these industries right now, there's some of your brothers and sisters out there who've done deals that are extremely dangerous should anything not go right. And anything not going right, that doesn't necessarily mean the place goes bankrupt. That just means they bought at a very high multiple. They're not able to create much value. The market goes south. They have to sell, and they sell for a level where there's no return of capital to the seller. And if the seller, in some of these deals have rolled 50% of their purchase price into these things, they might be very surprised 4 or 5 years from now when the business is sold and whoops, sorry, nothing left for you, buddy.
So this company that you blacklisted, do you think that company's looking for those people who don't know enough?
Yeah, I mean, they all are at the end of the day. I mean, and that's what I would do, and that's what I did do at American Capital. Like
in any good CEO is going to say, hey, if I can get a deal, I'm going to get a deal, right?
100%. I mean, like, look, the private equity firms live on proprietary deal flow, and they've got to go out and they've got to find sellers who, the best seller to ever find is the guy who actually thinks he knows a lot more than he does. The ones that I really have a hard time dealing with, if I were on the buy side, are the ones that are ignorant but actually know that are humble and sincere enough to say, I've never done this. I have no freaking idea what I'm doing. I'm going to go out and find brilliant people to help me. No, I want the guy who thinks he knows. So to your point, Jonas, yes, you need to go out. Private equity firms need to send out those emails, make those phone calls, wine and dine guys out there to find the guys that are not going to run a competitive process. They're not going to take their business out to market, run a proper process. And they're going to be ignorant to the fact that price isn't objective. It is very subjective. Valuation is going to be subjective across the board, and every acquirer is going to have a different assessment of value. Those are the types of guys private equity guys need to find. Those are the guys, by the way, if anyone listening to this wants to go out and do acquisitions themselves, that's what you need to do. You got to find those guys.
Yeah, for sure. And when you said a competitive process for the listeners, I'll give you an example. If someone says, "Hey, I want to come in and buy your company for $5 million," you're like, "Okay, cool, awesome. Take that same $5 million and go bring it to other people who are looking and see what they'll offer, right? Or take it to auction, right?"
There's a million different ways to run a competitive process, but you are 100% correct. At its core, it just means invite competition.
Right. And a lot of people don't do that. They're just like, oh, they see the money and they just get rid of it.
Yeah. When I talk about it, people are just like, oh, that's a sales pitch for what you guys do. And yeah, I guess to a certain degree it is. But at the end of the day, it's also common sense. And you don't need to hire an advisor. You should, whether it's us or anyone else that's qualified, you should do that. But if you don't, you should have bare minimum. If you're going to sell your business, you need to think about, if you're a lawn care business, you got to think about every single qualified potential acquirer and get them involved in that process. Because otherwise you might be leaving a lot of money on the table.
Yeah. And I remember also hearing podcasts a while back. I don't remember when it was. You were saying like, yeah, your lawyer is an M&A lawyer. And you're like, well, how many deals have they done? You're like, oh, they did like 5 or 10 last year. You're like, well, that's not a true M&A lawyer then.
Yeah. And I hate, you stated that right. It's, I've had, I've had some issues as of recently where, some of our clients have used attorneys that are super, super nice people, but they're not transaction attorneys. And that's actually very, very costly to a seller. It's the same thing. It's just like, hey, you got a heart problem, you go to a cardiologist, now it's time for surgery. I don't want that cardiologist unless he's a heart surgeon actually doing that work. He's a cardiologist. I want a heart surgeon, right? Like, I want to get the guy who specializes in the area of law that I'm focused on. And so I really can't recommend this enough. If you're going to approach a transaction, find somebody who is a transaction attorney. This is what I do. I do M&A. That's what you need to find. You got to find that guy.
Very smart. Very smart. Appreciate that. What are you, you're going to, I'll break this up in 2 different questions. What are you looking for on the sell side? And then also, what are you looking for on the buy side? And then almost like the opposite though, like if you were negotiating against either one of those sides, what would you negotiate at? Does that make sense?
You're a little complicated here for me. So on the buys, are we talking about a negotiation here, or are you talking about what I look for in a business? Or
Yeah, let's just go with the first question. Like, what do you look for on the sell side, and then what do you look for on the buy side?
so if I am selling a business, I mean, when I'm looking at acquirers, I guess if you're asking me how do I suss that up, I'm first off looking for acquirers that I know have the capacity, the financial capacity to actually do the transaction. I like to look for acquirers that actually have a history of making transactions, because for me, a very important data source is the performance of past acquisitions. I At the end of the day, when it comes down to dealing with our clients, it's always, everything that I do stems purely from the shareholders' goals and objectives. What do I always have these conversations with my clients. It's like, okay, so what is it that you want to accomplish? Do you want to sell 100% of this business and be gone? Do you want to roll equity and become part of a private equity platform? What is it that you want to do? Because if you just want to exit, sell 100% of your business, that's a pretty plain vanilla deal for me. And it's a lot easier for me to deal with. And then the question becomes, what's most important to you? Is it terms and price? Is it your employees? So on and so forth. And I would say that 90% of sellers start a process and talking about how important their employees are. And then by the time we get to the end of the process, all but 1 or 2 of them will say, I don't really care about my employees because I'm the one that took the risk and I want the most money, and I want the most money now at the closing table. And I think that's a fair way to look at it, because I think you can, I think that you can reward the people that have been with you all these years helping you build the business. And I think it's very important to do that, quite frankly. I think it's extremely important to do that. And I have a tremendous amount of respect for those people that actually really reward their team members. But you don't have to do it as part of the deal. You can do it outside of the deal. Who doesn't like a massive check or a wire transfer or a couple big pieces of suitcases full with cold hard cash? I mean, there's a million different ways you want to do it. But for me, when I'm running a sell side process, I'm spending a lot of time vetting potential buyers. And how I vet buyers is whether or not they do what I want them to do. Meaning, when I take a business out to market, the first step in the process after they sign an NDA is provide a proposal. So we'll send them sell side materials, and we want them to provide us a proposal, and we call it an indication of interest. We give them a deadline, and we say, Jonas, at 5 p.m. on Tuesday, the 19th, you have to provide a proposal for the acquisition of XYZ company. And in that proposal, we need to know the following things: the purchase price as a range or a definitive number, like how will you finance this? How much money is up front? What are the terms? What is reps and warrant? We'll have a million different questions, but you've got to provide that to me by the 19th at 5 p.m. And if you don't do that, you're not participating in the process. And then we go to the next step, and there's another deadline. And so one of the best ways to assess a potential buyer is how well they live to process rules, as opposed to trying to create their own. When I see buyers trying to fight against process rules, I know that those guys are going to be the first ones to jam at my ass during due diligence if something goes wrong. And I'm not, and so I try to get rid of them as soon as I possibly can in order to protect. At the end of the day, I run a protection racket for my clients. They pay me money and I protect them. That's what happens.
So when this is going to be very granular answer from you, because there's so many 100 ways to do this. But when you're looking at companies, you're trying to give them a multiple. And you're obviously trying to give them the highest evaluation. But what are you looking at there?
Yeah, I mean, look, I'm looking at a variety of different things. That's probably changed quite a bit over the years because the market's much more dynamic. But when you're talking about resi commercial services, particularly route-based residential services like lawn and pest, it really is a local market. And what I mean by that is different areas of the United States, for example, have different growth rates, weather patterns, so on and so forth. Immigration patterns, cities like Charlotte, for example, and Atlanta, those things are growing. In your neck of the woods, it's a net exporter of people, so to speak. And so you've got kind of the economic and demographic area, aspects of it. But on top of that, you've got acquisition activity, and where are acquirers actually making acquisitions, and where are their platform businesses? And, if you've got a pest control business in Iowa, for example, you could have a $5 million pest control business in Iowa. You would have less potential acquirers in a $5 million business in Fredericksburg, Virginia. And you might have the same economic characteristics. Exactly. Let's say carbon copy in both areas. That business in Virginia would sell for a higher transaction multiple than would the one in Iowa. For the pure and sole purposes, there's more acquirers, and every additional acquirer you get into an auction process, you potentially lift the price. So I don't even remember what the original question was.
Just how you evaluate customer or companies.
So I look at geography, right? So geography is number one. Number two, I look at the growth rate, right? So when you think about valuation, I think an important thing for everyone to think about is that when you think about the value of something, it really comes down to a stream of cash flow that you're buying, right? I mean, that's really what it is. If anyone's buying anything, any income producing asset, it's purely related to the stream of cash flow. And you're buying the future stream of cash flow. And so everything that influences not only the growth rate in that stream of cash flow, but also the durability or the risk associated with that stream of cash flow will impact valuation. Now, when people talk about value is really how the market is valuing that stream of cash flow at that particular moment in time. So you could have that $5 million business in Fredericksburg, Virginia, Instead of moving it to Iowa, let's take that exact same business, carbon copy it, and move it from 2024 until November of 2021. It would have sold at a 30% premium to where it would sell right now, just by moving it intertemporally back to 2021. Why? Because the market valued that stream of cash flow differently in 2021 than it does today. And so you've got two variables always. What's the greater market doing, and how is the market interpreting the value of that stream of cash flow? And then what are the fundamentals of your business doing? So I look at growth rates. I look at margins, right? Because the growth rate determines the growth rate in free cash flow. The margins determine the absolute or aggregate amount of the cash flow. And so for everyone listening to this, your most important margin is gross profit. That is your revenue minus your cost of services. So basically your technicians out in the field and all the chemicals and associated costs, your vehicles, the insurance associated with your vehicles. So basically everything it costs you to service those customers, subtracted from your revenue, gives you your gross profit. That is your most important number, because the SG&A cost structure, right? Everything under gross profit is relatively easily manipulated, and it changes based upon who actually owns that gross profit, so to speak, right? Like I'll give you an example. If Orkin buys it, I mean, they're going to get a lot of stuff cheaper than you're going to be able to get it. So I look at that. I look at how much of the business is recurring in nature. And I define recurring, not if necessarily if there's a contract, just if the customer and the provider both have a continuing expectation of performance.
Can I ask a question right there?
Yeah.
Say it's a one-time or a biannual, but it reoccurs every year for the last 5 years. Is that considered reoccurring?
That's considered reoccurring as opposed to recurring. So those are the two differences.
So this was like the third question that I asked originally. Like, how would you fight back on both sides?
Yeah, I mean, the good news is that, again, markets are dynamic, and as you have new buyers coming into the markets, they don't quite understand that. So depending on who you're talking to, you're not going to get away with that if you're talking to Rent-A-Kill. They're just like, you can piss off. But if you're talking to a financial sponsor that's relatively new in the industry and starts looking at a lawn care business or pest control business, you can kind of fudge and say, well, it's reoccurring because I can show you that this particular customer has called me every 6 months for 3 of the last 3 years. And so it's as good as a recurring contract, and they might buy it. When we do analysis, like we do a revenue analysis, and we look at the revenue stream of the business, and we tend to bucket it into recurring, right? And so that's on some sort of set frequency, whether monthly, bi-monthly, quarterly. Occasional, which is the reoccurring as opposed to recurring, and then one time. And so the occasional is kind of it's kind of like the guy who goes to the same restaurant every Friday for lunch, and he does it 52 years. He's not a recurring customer, but like until he gets hit by a bus or dies, he's coming to that restaurant. So there is some value there.
Yeah, I like that. Switch gears a little bit. If you were to start a pest control company today, how would you start it? And what would you do for the first 2 to 3 years?
Yeah, I don't often think about starting a pest control company.
I know you don't. Well, I've heard you talk about this before. That's why I'm asking.
Yeah, I try to think about both on the pest and lawn care side, as we talked about prior to the start of this episode. You and I chatted a little bit on the front end of this. I mean, there are some pretty strong secular tailwinds. And what I mean by seculars are not cyclical. I mean, they are trends that are great for both industries, which is the younger people tend to outsource services. No one wants to be bothered like being out in the hot afternoon, like fertilizing or doing any of that sort of jazz. So I think you'll see increased penetration in both of those industries over time. They're good places to be in, I start to think, so for me, one of the things that I think about, it's like, where can I deploy? I want to be involved in something, and this might be counter to the message that you want to talk about on your podcast, but here's the way I look at it. And I don't want people to be discouraged by this because I think these are great industries. At this point in time, I would have loved to start a pest control business back in 2003 and have it be doing 40 or $50 million a year right now. Right now, you've got all this capital flooding to these industries. You've got companies fighting online. It's getting very, very competitive. It's also you got hot money rolling into it, so asset values are high. I want to get into something when everyone, I want to get into something when prices are low. I want to get into something that people don't like, right? It's always like business and investing is the area in which everyone gets excited when prices are high, but no other area in life do people get excited about high prices, right? You don't go to the grocery store and be like, oh shit, tomatoes are $20 a pound. I'm super excited. They were only 15 a pound last week. No, and so as these prices get higher, returns naturally get lower. So I don't think about starting a pest control business, but if I did, I would probably, if I really were going to do a pest control business, I would probably start to think about it from the perspective of, we had Jared Lejeune, right?
Oh yeah, I know Jared really well.
Yeah, Fat Pat and I talked to him on the Buzz a couple of weeks ago, and we were talking about the fact that he started in BFE, Louisiana. And he's like, you know what? Like, if I could do it over, I wouldn't have started here. I would have gone to some other, maybe another place in Louisiana or outside it. And I think there is something to that, like figuring out from a competitive perspective, where's the best market to be in. I've long said that I like the Midwest. I like the Midwest because Mother Nature is just a nasty barrier of entry up there, right? Like there's tons of seasonality. Now, it is competitive, but it's not nearly as competitive as the Southeast. And how do I know that? Because I don't even have to look at the number of pest control companies or lawn care companies. All I have to do is look at pricing. That tells me everything. In a very competitive market, price is driven down. And I know that pricing is way lower in the Southeast than it is in the Midwest. That's all I need to know. So I think that I would be very specific and say, okay, am I doing this to build an asset? If I am, I need to find the right place to do this, and let me uproot my family and go to that place and start it. Or I won't uproot myself, but I'll travel there quite a bit and I'll hire people. So finding the right geography, I think thinking about the right services, and getting yourself in the mindset that you're actually you're killing bugs, but at the end of the day, what you really are is an insurance company providing a warranty. And that warranty, sometimes you're required to deliver services. So if you can put yourself in the mindset of almost thinking like an actuary and say, okay, how do I go out there and get every house and business in this area under my quote unquote pest control insurance program, which is a subscription or a contract. And, I think places like Michigan have termite pressure, but they're not nearly as bad as like Arrow country in the Southeast. So, selling Centricon baiting systems all day long up in the Midwest is a great way to do that. I don't know. I can probably blabber on and on and on all day.
Would you hire a door-to-door team? Would you build a door-to-door team for the first year or two to get you to scale, or would you do it all traditionally?
I'm kind of the older I get, I used to hold a lot of opinions, and the older I get, the less I hold opinions and the more I try to focus on data. So I'm going to be frank with you right now. I can't answer that question because one of the things I'm really trying to get my arms around is, I have these discussions, and I just had a discussion with Matt Rogers on Potomac TV. We just kicked off this marketing series Matt and I are doing, and Matt's over at Lizard. And we sat down, and in the first session, he tells me, hey, I can do better, than door to door from a cost of conversion perspective. And I'm really trying to, I'm really trying to figure out what would be the best way to do it. I can tell you from a door to door perspective, my gut reaction is it's probably a good idea to do that for the first 1 to 3 years, because you can establish a territory rapidly. You can be very specific about where you begin that business and where your service footprint is. Um, but then I would try to get off the crack cocaine of door to door as quickly as possible, just because it is prohibitively expensive and it's only gotten more and more expensive. So I think my gut tells me I probably would do that, but I still need to poke into the data a little bit more.
For sure. Yeah, and I do agree with you wholeheartedly. Like I think, it's spinning up a door-to-door team for the first, 1 to 3 years, like you said, and then just moving to more traditional marketing from there. But you already have established a location.
Are you doing door to door up there?
Yeah, but only in certain markets, not all of them. But that's just how we've got them off the ground quick. But then we don't want to sit there very long either, So again, we don't want to ruin a reputation, but we want to stand up a solid branch with a base.
Mm-hmm.
So that's what we've done. You see a lot of CEOs, like you meet best of the best. And I know you talked about this at an event recently, and I think I might ask the question. But for the listeners, what do you see the difference in CEOs from the really, really good ones to maybe not so great operators? What makes them good?
One of the things that I try to figure out when I'm talking to a CEO is this guy a leader or a manager? And both are obviously extremely important, but I think that over time, one of the things I've tried to really understand is, like, when I sit down and listen to this guy, am I inspired? Right? If I were on his team, would I want to go into battle with this guy or gal or not? And um, again, you have to have, if you're an operator, you have to have managerial skills. You've got to be able to delegate things and so on and so forth. But I find that one of the most important things, or aspects of a CEO versus just a typical manager, is a true leader that actually is setting goals, inspiring the troops, and also reducing ambiguity in a business, right? And, as a business moves in time towards the future, the environment is very ambiguous. And so you need one guy or girl to be able to look at this and say, here's the mark we're attempting to hit in the future, and make it very clear and unambiguous for his entire team. And so those are the things that I've really honed in on when I have discussions. I'm like, okay, is this woman, is she dialed in? Does she have a vision? Is she inspiring? Is she somebody that I would want leading me in an organization? I think management skills, I think it's much harder. I think both can be learned. I think you can learn to be a leader, and I think you can learn to be a manager. I think it's a little bit more difficult to learn to be a leader than a manager, though. And I feel like, it's interesting because, now when I sit down with some of these people, um, I'm just like, holy shit, this guy is awesome. And then sometimes I'm like, yeah, I'm surprised, like, anyone wants to report to this guy at all.
Yeah, you think that the leader has to have a really good vision and be open and no ambiguity in there at all.
Yeah, and it's not that there's no ambiguity, but it's just like reducing ambiguity and providing clarity for the team is one of the most important aspects of a leader's job, right? A commander's intent, so to speak. And like, I find that doesn't come natural to most people. It certainly doesn't come natural to me, but I do think that that can be learned and practiced over time. It's not just about, I think a lot of people look, oh, leaders have to be naturally charismatic. I don't think that's the case. I think that this actually I think you can sit down with a pen and paper. I think you can start to think through this. I think there's a recipe to being a visionary in your organization and being a leader. And I don't think it just has to be an innate skill, because I've seen people who I know are not and who have grown to be over the years that have watched them do that. So I think there's hope out there for all of us. I think the first thing is just understanding that there actually is a distinction between being a leader and a manager.
That's solid advice. Another great one. When it comes to like deal structure and selling out the company, and you talk about holdbacks and earnouts and things like that. What do you typically see majority of the time that people are selling?
Yeah, I mean, the majority of our deals right now are typically somewhere between 95 and 100% cash at the closing. Every once in a while, we'll do a 90% deal. We don't do a whole lot of contingent holdbacks anymore. I mean, sometimes they're 1 year escrows. And so, if we'll talk about this for a minute, whenever you sell a business, everyone always says, well, why don't I get all my money up front? And sometimes you do, and larger businesses, it's not uncommon to get all of your money at the closing table.
So like, if you see online and all the Facebook pages and groups, this is what you see all the time, right? Like the smaller companies that are trying to do it themselves, and they'll be like, oh, we'll put 70% down and 30% over the next year for an earn.
Yeah, and and if you've got $1 million or $2 or $3, $4 million business, you're gonna end up most likely having some sort of a holdback because, if I, for example, come in and buy your business, and I write you a check, I might say, well, wait a second, I want to hold some of this money back, and I want to make sure that everything that you told me in this purchase agreement is right. Like, for example, I want to make sure that you're not committing fraud. I want to make sure that you don't have this massive liability that'll somehow succeed to me that I'm going to end up having to pay for. I want to make sure that all the assets that you told me I bought, that I actually really have title to those. I want to make sure that, a government authority doesn't come back 6 months from now looking for taxes from you and coming to me. So there's a myriad of things that can happen post-closing. And so usually for a period of 1 year to 18 months, sometimes 2 years, but let's call it 1 to 2 years post-closing, all this dust kind of settles and we make sure, okay, Jonas, you actually told me the truth. I paid you money, but I got what I expected. So here's the remainder of your money. And that money can be held in two places. It can be either held in a third-party escrow, like some sort of a bank holds it and there's an escrow agreement, or I, the buyer, hold it in my bank and say, hey, this is my money until I pay it to you. But as soon as, you live up to your, we're assured that you weren't lying to me, you'll get your money. The old school way of doing it, and what you'll see, I guess, on a lot of the online stuff is that, back in the day, and this still happens, and it happens a lot with smaller businesses, like, you sell $1 million business and somebody writes you a check for 50% up front, and then they pay you out the rest over time, and they pay it on whether or not they're going to retain customers, right? Did the customers stick around? And I always say that was just shorthand or a crutch for DD, meaning somebody didn't verify the existence of those customers. So let's just write the guy a check. If the customers didn't exist to begin with, that doesn't matter because we'll just keep the money and so on and so forth. That's how it tends to shake out.
Right. Yeah, no, I get it. And then because you hear a lot of people will talk about earnouts on a deal too. I was gonna say, how many services typically do you see that those customers need to take before they don't count as a cancel?
Yeah. So if you're talking about the old contingencies, which to a certain degree exist today, but if I were going out and buying a pest control business, for example, one thing that I might do is I might say, Jonas, I'm going to write you a check for 50% upfront and 50% over time. And every one of your customers are on quarterly, so they need to take and pay for 2 services post-closing. And when they do that, I'm going to consider them a customer and I'm going to release that to you. I would say what we call them is 2 take and pays. So 2 services, whether they're monthly, quarterly, whatever, 2 services taken and paid for by the customer post-closing is kind of industry standard.
And I remember you mentioned, I had notes about a cancel basket. Can you explain that? It's kind of the same thing?
Yeah, a cancel basket might be something where I'm expecting, in every single deal, there's going to be attrition. Well, I shouldn't say every deal. I would say that on a deal with a big strategic player like an Orkin or a Terminix, you can assume that Orkin and Terminix, some of your customers, I would bet, used to use Orkin or Terminix and do not like them, right? And there's a reason they're using you and not Terminix or not Orkin. And so if Orkin comes back in and buys that business, that customer might say, F off. And now you're like, okay, well, wait a second. That's not my fault. Like, I did a great job for that customer. They don't like you, Orkin. And so what a cancel basket is it just assumes that there's going to be some sort of natural attrition. And, it might be 2% of the customer base or 5% or what have you. And that way you, the seller, are not getting dinged when 1% or 2% or what have you leaves. And again, these are in the realm that I play in. I mean, I haven't looked at a cancel basket and I don't remember how long. However, going out buying one of these businesses, for sure, this is an everyday occurrence that people should be focused on.
What's a good attrition rate when you're purchasing a company?
And let me make sure I understand you specifically. So I go out and I buy a business tomorrow. How many of those customers am I going to lose?
Yeah.
I mean, in a perfect world, if I do things right, and I don't have any of the kind of predecessor issues that like Orkin would have. Like, let's say that I'm a new company and I'm just moved into a market and I buy a business. Ideally, my attrition rate should be your attrition. If I just bought your business, I should step in your shoes and your natural attrition rate should just continue to exist, because what I'm hoping is that I don't scare off any employees. I don't scare off any technicians. I don't piss off customers right out of the gate. But you always do have to expect some of that stuff to happen. So I always say that you're probably going to lose 5% of those customers in the first 6 months is probably a decent rule of thumb.
And then what about after the 6 months to a year? Is it an additional 5%, or you see?
No, you should. It within 6 months, it really should start to hit whatever the target's natural attrition rates are.
Okay. Puerto Rico. Why did you move there?
Oh, it's a couple of reasons. Well, first off, there's zero tax here. Well, it's not zero tax. I shouldn't say there's zero tax. There's no capital gains tax. There's extremely low income tax rates. So taxation was a primary reason for my move, but not exclusively. I was living in Switzerland and I was doing like 50 or 60 transatlantic flights per year. So that was really tough, and I wanted to be closer to the United States, so I would have to travel less. And so that was a reason. Another reason is, I lived in Europe for many, many, many years. In the winter months, there's a dark cloud over Geneva, Switzerland, and you get no vitamin D, and you look like a corpse. And I got tired of the cold, to be honest with you. Like, I don't know how you deal with it up in Michigan. I mean, that stuff, I just can't deal with it. And so it is, Puerto Rico has, in my opinion, I've lived in a lot of places. This is the best weather year round ever. Like, just every day is a beautiful, sunny summer day, and it doesn't get too hot. So I love it.
Cool. And then you started doing events there recently, right? I have some good friends that were just down there messaging me and sending me cool pictures.
Yeah, it's one of those things. It was kind of ad hoc. The Mexican kind of started throwing these things around. We are, we get a lot of people that come down to Puerto Rico. It's super close to the U.S., obviously, and people will like to pop down. And it's one of the actual, when I was in Switzerland, I would get people coming on occasion from the U.S. And I had clients on occasion, but it wasn't like every other week there's somebody coming down here. And the Mexican and I were talking, and we said, you know what, like, people come down here a lot. Like, we should start to try to organize this into some sort of more formal thing. So I think every 90 days down here, we're probably going to have 20 or 30 people down here. I'm getting into deep sea fishing, so we're going to do it. There's a lot of that great stuff here in Puerto Rico. We're going to start doing that. And then the Mexican has like this whole, like, he wants to do this Potomac 100 thing in the winter, where he wants to make it like this exclusive, invite only event every winter. Not like what Seth is doing with like Power or Energy, where there would be speakers. Like, it's actually the Mexican's idea, and this is going to sound, I can't even believe I'm saying this. It sounds going to sound so stupid when it comes out of my mouth. He wants it to be like a conference about nothing. He literally wants people to come down here. He wants to get like very smart, driven business people, not to come down and watch speakers, but to come down and actually do shit together, meet each other, have dialogue and discussion, have drinks, talk about things, because in his opinion, most of the learning goes on like outside of the stage, so to speak. So anyway, we'll see how this. This is all on the drawing board. I don't know what's going to happen.
When's the next event?
We don't know yet. I think probably, I've got to go to Asia, and then Europe in July. We're probably going to do this. I'm thinking probably sometime in September is probably the next event that we're going to do. You coming down?
I would love to. That's where I was going with it. I just reached out to Seth last week, and I was like, "Hey, I need to get down there. How do I get there?" He's like, "Just ask Paul."
Yeah, just come on down. Yeah,
awesome. I have a couple more questions for you, and then we'll wrap this up because it's been going on an hour and a half already, which is awesome. So I appreciate it. What are your I'm gonna leave them for the end. What does the next 5 years look like for Potomac Group?
Are you trying to determine whether I'm a leader or a manager?
Yes.
Yeah, we have really gotten focused heavily in a lot of the allied industries outside of pest control. So we're going to be
HVAC, plumbing.
Yeah, we're going to be at the Fire Protection Conference in Orlando. I'm super excited for that. We actually have, we got a ton of people going. We're doing a lot in roofing now, weirdly enough. So basically, resi and commercial services. So what's going to happen here? I'm continuing to beef up Puerto Rico, which will remain our headquarters. This summer, I'm going to start to kick off again. We used to have an office in Geneva. We're going to get back to Europe. I think there's a lot more opportunity there that we really haven't tapped into. So we're going to start to focus more on Europe and Southeast Asia. I think we're always going to stick to our knitting. Like Potomac will focus purely on valuation and M&A, and it'll focus purely in the niche industries that we focus on. If we do something, I want to be the best in the world at it. And so I think we've done that in pest control. It's the only thing I have in my life that I can say, like, I'm the best in the world at this one thing. This is what we do. And so we've started to roll it out into other industries, and we're doing it very slowly and we're doing it very methodically. And we want to be the absolute best in what we do. Other than that, I got no exciting plans.
Incredible. What do you see the next 5 years in the pest control industry looking like?
Yeah, I think the financial sponsors will continue to get deeper into it. I think we'll have more and more private equity backed businesses. I think you'll probably see a pretty decent wave of consolidation end of 24 and 2025. So I think you'll start to see some movement on the top half of the PCT 100 over the next year and a half. I think you'll probably see Anti-CMEX go public in the first half of 2025.
Which just makes more room for the top 100, right?
Yeah. Yeah. I think there'll be, I think there's going to be, I think the industry is starting to get more and more sophisticated. I mean, I freaking loved having these. We had like 20 or 30 people down here last month.
Some heavy hitters there too.
Yeah, it was awesome because I really, I'm like sitting there having drinks with guys and just hearing all the cool shit that everyone's doing. So I love the fact, like, this didn't exist in pest control 10 years ago. Like, this did not exist. I didn't have people that just had this sort of drive and this sophistication. So it's actually exciting, This is not a boring blue collar business anymore. These are guys that are doing cool stuff. So
it's really cool. Have you ever thought about being an author?
Yeah, I think about it all the time. As a matter of fact, I have a lot of notes and an outline of something. I hate to even say it in public. I hate to even talk about it because I don't know if I'll ultimately do it. But I have been, I write a lot, and I'm thinking about publishing kind of my experience of what I've learned in pest control over the last 20 years, all the good, bad, and ugly, which I think would be helpful, especially to the younger guys that are getting into this or early in their journeys. So yes, I am considering doing that.
And I know you read a lot too. You gave me some good recommendations at the conference we were at, but what are your let's just say your top one or two favorite books that you read multiple times. It doesn't even have to be anything business related, just in general.
There's so many of them that I was just rereading The Most Important Thing by Howard Marks, which he's a fund manager. He manages a business called Oak Tree. I'm actually an investor in that business. That's a great book, and it's not particularly relevant to a lot of pest control and lawn care operators out there. It's a book on value investing. So I'm a big fan of that. Um, I'm just rereading right now Cialdini's book on influence. Have you read that?
Yep, it's a really good one.
Yeah, I wouldn't call that a favorite, but
Yeah, I wasn't putting you on the spot. There's just a lot of good books out there. So if you have one that I've never read, I'm going to take it down.
I'm rereading now also the Heath Brothers Made to Stick. Have you read that?
No, what is it?
Made to Stick. I really, as of recently, hold on, Made to Stick. I thought this was interesting. Although from a more business perspective, The Power of Moments. So this is Chip and Dan Heath as well. And I do like their writing. This, I think, has a lot more relevance to business. And basically, it just talks about exactly what it says, the power of moments. And it talks about, they go through, what things are very memorable and pivotal, like even from a customer journey perspective. So it's a pretty easy read. And I think there is some stuff to pull from it.
That's the library sitting behind you.
Yeah. I'm reading now. I got a lot of stuff here. I'm reading Letters from a Stoic now, Seneca's compilation. This is plain reading. I try to read a variety of different things. Another book that I'm actually reading now that I really, really am enjoying, and it's a super breezy read, is Thinking Backwards. And it is it's a book written by two former senior executives at Amazon. And I know there's a million different books written on Amazon. I probably have half of them on my shelves back here. That is a great book for a business owner. I highly recommend it. It's not extremely heavy reading. And I like what it talks about from an HR perspective. They talk about Amazon's bar raiser. They talk about how they've established their core values. And I actually like it a lot because it's, I won't go into it. You should read it. I liked it. I think it's a good book.
Awesome. Last question of the day for you. What are you most proud of, Paul?
I'm probably most proud of the team that we've built over here at the firm. It's like one of those things where I think every business owner can kind of relate to this to a certain degree. And some of them very much so. And I know this because I have to deal with it every time they sell. Like, if you really put your heart and soul into an organization and you spend a lot of time trying to go out and find great people that you actually care about, it's hard to separate that from your actual family, right? Like, it's like you've created a surrogate family within your business. And if you really do care about the people, it can really become a great place to be. And so I'm actually very proud of, what the team here has built. I'm proud of the organization. I'm proud of the accomplishments that everyone's been able to perform here at Potomac. And, to a certain degree, I've had a strong hand in being able to set that. But at the end of the day, I guess that's one of my greatest accomplishments, really. You ask me questions, Jonas, that I don't think about.
That's why I asked them.
Usually I'm the one asking questions. Yeah.
I want to know. I want to know what goes on in that mind. To what I can be thinking about or what I should be thinking about.
Yeah. No, I'm proud of that for sure.
Well, awesome, Paul. Again, thank you for your time. I appreciate you. You have all your links in your bio and everything in the link. So they can just click on it and find you. And anyone who's going out there to, sell their company, make sure to reach out to Paul. And what size companies do you typically work with?
Yeah, I mean, pretty much all over the map, kind of that $1 million range all the way up, $1 million up.
Awesome. There you go. Well, you got all the people that are listening. If you ever think about selling, make sure to hit up Paul, Giannamore, the Potomac Group, and wise man. So I appreciate your time, Paul.
Well, thank you for having me, guys. And again, congratulations on this very special 100th episode. Keep it up.
Awesome. Thank you. Appreciate it.
See you down here in September.
I'll be there. Hey guys, thanks for listening to another episode of Pest Control Millionaire. We don't charge any money for the show, obviously, but the podcast isn't free. You can pay for the podcast by sharing it with your friends and your family. So please like and subscribe and give us a 5-star review on your favorite podcast app. These things make a huge difference for us. If you have any specific questions you want answered about the business or your life by me or my guests, send an email to info@pestcontrolmillionaire.com. And if you want to get in touch with me about any personal business coaching, check out our website at www.pestcontrolmillionaire.com. Thanks again for listening, and I'll see you guys again on the next one.